The last point I'd add, and I didn't have it on the slide here, about the macro outlook for 2012. This is probably more of a early 2013 issue, but if you enjoyed the political theatrics of August 2011, then you are really going to love the end of 2012. I apologize for the sarcasm, but you should know as investors that there could be some increased volatility at the end of this year, specifically related to politics. Again, I don't intend to change my investing philosophy in the least. If anything, it could be opportunity for us to take advantage of that volatility and maybe look at averaging down, getting into some new names, that sort of thing. But just so at the end of this year, we're going to see, and by we I mean America, is going to see the end of the President Bush's tax cuts. Those are going to expire. That, if you try to quantify it, around $250 billion. We're going to see the end of this payroll tax holiday, as well as the emergency unemployment benefits. Call that another $150 billion. We're also going to see the automatic budget cuts kick in due to the failure of the super committee, and that's another $100 billion we're looking at right there. So all told, it's about $500 billion worth of really sudden fiscal tightening all at the end of this year, and that is really unprecedented in modern times in the U.S. and anywhere else, essentially. If you also, and I hope I'm not bumming everybody out, if you also factor in that the debt ceiling, at this point, looks like we could hit that again in December, and we all know sort of what a political morass that was. And, if you just presume that it's an election year, probably not going to get any movement on any of these things until, December at the earliest. It all, on paper anyways, is just something in the back of my head to kind of keep an eye on. Again, I don't intend to change anything because of this. I suppose, depending on things, it could mean that if certain companies we own hit their fair value estimates in my head later this fall, well, then maybe it makes sense to, after selling them, leave that money in cash for a little while longer. But it's a slippery slope, and I don't want to commit to doing anything at this point. We'll just sort of see how things come. But I think it is important to sort of just aware that is coming down the pike, and it is something that could be a really more annoying headlines than anything. But it is something I would add to a sort of macro overview of the next 12 months, I suppose. Again, I hope I don't bum everybody out. It just is what it is. Let's shift gears a little bit and talk more specifically about Tarpon. Right now I own 16 companies in there, and I'll show you those in a minute. The weights, and I manage everything in the portfolio by weights, anywhere from 5% to 9%. At least those are ones that I sort of initially dial in. I'm happy in most cases to let the weights grow if we have a highly or largely overweight position in something. It's usually because things are very cheap and prospects of that particular company are good. So I tend to let those run, if you will. That's part of the benefit of compounding is not taking money off the table too soon and just being a partner of these companies as they do well. The second bullet there, it is what it is. It's just sort of a snapshot of what the market cap distribution, if you will, of the things in Tarpon look like. I don't manage that in any particular way. That's strictly driven by where I'm finding the most values out there in the market. We are, as you can tell from the sort of micro/small cap weightings there, the portfolio right now is more heavily weighted in sort of your smaller companies. That, I think, is a reflection of a lot of things. I really enjoy spending most of my time on smaller companies. I think I can add more value as a portfolio manager there than, for instance, being the 35th guy to really look hard at General Electric and that sort of thing. So, again, it is what it is. I don't manage things with that in mind. It's just a snapshot today of where it sits. Our biggest positions in Tarpon right now, Clearwire, Wells Fargo is WFC, MMR is McMoran Exploration, DDAIF is Daimler. I'll talk more about McMoran and Daimler in a minute. Jefferies is also one of our biggest positions now. Jefferies wasn't dialed in originally as one of the largest positions. And I'll talk briefly about Jefferies in a second. It just happened to grow into it. We've had a good run in the last 2-3 months. I mean, it's a position that's gone up about 50% in about 3 months' time. and I simply haven't done anything with it yet. So haven't trimmed any back, don't really intend to. I feel good about Jefferies in many respects, so that is on the top 5 list, though not necessarily by design. The biggest sectors that Tarpon is invested in: financials, which I alluded to earlier, technology, and energy. And again, I want to differentiate. I'm not trying to guess which sectors out there are the most undervalued and then go look in those sectors for the best prospects. That's that top-down approach. I'm coming at it from the other side, and all the looking I'm doing, well, the most undervalued companies I'm finding happen to be financials, tech, and energy, so the portfolio resembles that. It's a bottoms-up approach as opposed to being really too didactic or trying to figure out what's cheap and then add more stocks there. That's not how it goes. It's sort of an organic progression of things. Here are current Tarpon holdings. This is still recent. It was recent 2 or 3 weeks ago, the annual meeting, and I haven't made any changes since. I hope not to for a while. I'll touch on some of these fairly briefly, and others I'll talk more about in the slides that follow. These are just straight alphabetical order, so no particular order to them. Acme Packet, it's a telecom services provider that has really the dominant share of what I would call a critical niche in telecom that enables, among other things, voice over IP networks to work. I'm not a big fan of big box companies, of hardware / box companies when it comes to telecom. There's a whole other discussion. I don't particularly care to own router companies, switch companies, if that's all they do. There's just too much technological risk there for me. But I do happen to think Acme Packet is really more like an enterprise software company than sort of your typical telecom box provider. And a whole other discussion, but it is in the portfolio, and perhaps can write more about them in a letter before too long. Clearwire, I'm going to talk more about soon. Daimler, same thing. First Marblehead, same thing. GSL, Global Ship Lease. A familiar name for folks who've been in Tarpon for a little while. Started a couple years back buying shares of GSL. Pretty much sold out. Still had a sliver of our position in that left. After there was a fairly big rise. I guess this was 2 falls ago. Once things got to about the $7 share range, didn't completely liquidate, but got rid of the majority of our holdings, and then have sort of been restocking, if you will. Shares have since fallen back. We now have what I would call a full-size position in it, and I guess I would refer you to the investor letter I wrote 2 years ago to talk more about GSL. But at a high level, they have 17 container ships. They're chartered out really to its parent company on long-term contracts, so there is some sort of built-in protection around the revenue streams that I greatly enjoy, or put a high value on, I guess I should say. GSL is based in London. The parent company is based in France, and I guess I'd leave it at that for now. Jefferies, I would consider Jefferies probably to be the leading sort of second-tier investment bank. I think they're on their way to becoming a first-tier bank, candidly. And again, strictly capital markets and asset management, not a CDO factory in any way, shape, or form, so avoided much of the mess that really did in a lot of the bigger Wall Street investment banks. There's probably a good case study to be made about Jefferies in terms of maybe how not to short a company. Jefferies was, the stock price was pummeled late last summer, early last fall. I'm not sure if everybody remembers the collapse of MF Global, but given what was going on in Europe, a lot of angst, a lot of noise, really what ended up being blatantly just wrong reports, wrong analyses done by credit rating agencies, on Jefferies, and again, probably worth talking about more at some point, but hope to hold Jefferies for a while as well. LodgeNet really has a near monopoly on cable TV to hotel rooms. They're expanding into other things, games, that sort of thing, more sort of a broadline entertainment company. But there is another lever in their business in terms of rolling out HD. Just some fascinating economics. And again, there is a moat there, but shares are really trading at such a fraction of what I think normalized cash flow is that it's simply too cheap not to look at. So we've LodgeNet is in the portfolio, and probably will be for a little while still. McMoran, going to talk more about them shortly. Pacer International, again, I refer you to one of the letters I wrote 6 or 7 months ago. Pacer's a transportation and logistics company. They have a particular emphasis on intermodal shipping. They're also sort of in the mid or maybe mid to late stages of a turnaround that's been remarkably successful. So have held Pacer for, I want to say it's a little bit under a year still, but I would guess all signs are looking good on the turnaround they're in, and no intention to make any changes to that position anytime soon. Pharmathene, special situation biodefense company, probably worth talking about more at some point. Primero Mining owned the San Dimas gold mine down in Mexico. It's worth talking about that for a second as well. There is currently a multi-decade-wide discrepancy in the historical relationship between gold bullion and the miners themselves. In other words, gold mining equities like Primero are trading at the biggest sustainable or sustained discount to gold since really the early 80s. I think it's a fair question. Okay, well, why is that? I think you can really just look at the investor base. ETFs, or exchange traded funds, have really made buying gold itself that much easier the last few years in particular. So I think a lot of people who you'd characterize as gold bugs, which I am not, but really can get that exposure to gold using ETFs instead of mining stocks like they might have in the past. Without that aspect of things, the gold miners really trade, if you will, a lot more like regular industrial stocks. And normally I'm not particularly too concerned about how things might trade or sort of more technical aspects of any investment, but it is sort of interesting to me trying to explain the gap between miners and the price of bullion specifically. And you can actually look and see the correlation with gold price between miners and price has been really sort of in a downward. It's been sort of decoupling, if you will, since 2009. So that said, it just sort of explains, I think, what is a bigger discount there. Primero is probably worth writing up in a letter at some point as well. And to be clear, I don't have any opinion at all really on what the proper price of gold might be. I'm not sure anybody can, although people certainly try. In my mind, the same characteristics apply to a gold mining company that do to any other investment. Specifically, is there margin of safety there? What is a sustainable stream of earnings coming out of things? In this case, gold, I will tell you, I do view it as, and another portfolio manager put this quote out, not with relation to Primero, but I thought it was good in general about owning anything gold related. It is a hedge against political idiocy. So, I guess I do have that bias a little bit. I like having that in the portfolio for that reason. Primero is one of our smaller positions, but it's also another company tried to acquire Primero for a price in the 4s not too long ago. Shares have since drifted below 3, so there is some, you can sort of triangulate on what the fair value is fairly easily, both looking at a fundamental basis and seeing what else is out there. And Primero is in the portfolios too. Relatively new addition, but it's in there. Grupo Prisa, I will talk more about soon, so hold that thought. And this is really the B shares, but I'll get more into that in a second. We do own a REIT now in Tarpon, ROIC. It is a real estate investment trust that focuses really on sort of community and your neighborhood shopping center. So not necessarily big skyscrapers, kind of the other end of the spectrum there in terms of real estate investments, and the kind of places that are anchored by big chain stores, supermarkets, drugstores, that sort of thing. I think everybody knows Staples by this point. Interestingly enough, Staples is actually the second largest e-commerce company out there. Amazon's the first. Staples is the second, believe it or not. Not a lot of people know that. Ultra Petroleum is our newest position. I'll talk more about natural gas when I get to McMoran in a second. Ultra is an onshore natural gas exploration and production company. Most of their assets, or most of their activity anyways, is really focused in two areas, Wyoming and the Marcellus Shale, which people are probably a lot more familiar with. That's in the sort of North Pennsylvania area. Ultra really has just a cost structure to die for, from my perspective, when it comes to getting natural gas out of the ground. Lastly, Wells Fargo, again, long-time holding, familiar name for most of you there. I will point out that the most recent, unless there's been another issue since, but I believe it's still the most recent issue of Forbes that has come out, has a great cover story all about Wells Fargo. So I should probably throw a link up on the blog about that. But Wells is still in the portfolio as well. I'll point out that some of these names are relatively new to folks, depending on how often you check your account. Some of them have been in there a while. Turnover in Tarpon specifically has been higher than I would have liked. It was right around the 55, 56% a year point coming into 2011. Had some significant turnover, so our turnover, although I haven't calculated yet what it is on a 3-year basis, it probably is higher than that, maybe 65-ish, something like that. That, though, I don't manage the portfolio for turnover specifically. It's probably 4th or 5th on my list of things I think about when I manage Tarpon. But I do want you to know, in an ideal world, I'd love to not make any trades all year and just sort of sit back and watch things and not do anything. Just let our companies grow and really stick by them. The reality of the last few years has been a little differently, though, and there are we have had, in all that volatility, a lot of our companies have reached what I believe they're worth or near what I believe they're worth relatively quickly. So that's also impacted, and led to sort of higher turnover than I would have really would care for. But again, it's nothing I'm really losing sleep over. I hope none of you are. I think turnover in the future is probably going to go down dramatically. Knock on wood, once a little bit more stability returns to the market in many ways. So my 2 cents there for what it's worth. Let's look a little bit closer at 5 of these companies that we own. I'm not going to, at this point, speak much at length about Clearwire. My suspicion is, though, that if you Google Cale Smith Clearwire, you will have more than enough info from me right there at your fingertips. I feel like I've published, and by published I mean put on the internet, a lot of my own rationale, my own thoughts on Clearwire specifically. It is the largest position in our portfolio. I have a high level of conviction about Clearwire, although the ultimate valuation of Clearwire is quite challenging and difficult. It's fairly clear to me that whatever that value may be, and I think I have a beat on it, but whatever it really may be is significantly higher than where shares trade right now. Clearwire, though, it makes good conversation at the meeting, I suppose, because it is an example of really sticking to your circle of competence. I think most of you know this, but maybe some of you don't. I spent about 4 years working in telecom and telecommunications before I really got over into the finance or investment industry, if you will. 3 of those years, first year spent working at what was the world's first commercial ISP, so the first company that provided internet service to businesses, essentially, and then spent 3 years working at an RF engineering company, a radio frequency engineering company. Basically, we designed wireless cellular networks for all the big boys, for AT&T, Nextel, VoiceStream at the time. So my point to you is I feel very comfortable in the telecommunication space, and really within that space, really in anything RF, radio frequency related. And when you're talking about RF, you're talking about spectrum, essentially. Clearwire, the investment case really boils down to, or one of the investment cases you could make boils down to, just having a massive asset. In my mind, the case right now for Clearwire is all about spectrum. I threw some FCC estimates up there about mobile data demand. Other companies, Cisco particularly, has its own estimates, and the actual numbers aren't as important as much as 2 things. I guess number one, there will soon be a spectrum shortage out there. That's really driven by, as you might suspect, the iPhone, the iPad, a lot of data-centric services that people are just using without even thinking about it much. It's just become a habit every day, and that is a good thing in the long term for Clearwire because it has more spectrum right now than AT&T and Verizon put together. So much deeper discussion we can go into about different kinds of spectrum, RF, propagation frequency. It doesn't even matter at this point. At this point, I guess I would point out to you that still own what I believe is a large position in Clearwire, still intend to hold it. It's going to take a while for things to pan out. I'm okay with waiting. There are, I think, a lot of other investors in Clearwire who might be sort of more generalists, and I think it really explains a lot of volatility. There's just a lot to the story. I feel, without being overconfident, I feel like I have a good handle on the key attributes, and at this point, I'm just sort of waiting for the company to continue to execute on its current plan. And lost in a lot of the short-term noise too is that Clearwire, it's a little bit unique, really, in the technology space, in that I feel like it's one where, and that might be too grandiose a statement, but my point is, Clearwire's strategy is really now aligned with this technology, and I'll sort of fast forward through that whole discussion, but it is in the process of assembling what could be a very defensible moat, i.e. being the low-cost provider in a commodity industry. If the commodity is simply bandwidth, then Clearwire is positioning themselves well. Have some challenges ahead of them, nothing like they had 6 months ago, a year ago, but if you want to know more, I would say just Google my name and Clearwire and go nuts.